So it's been a nail-biting week for Nigeria's financial markets, coming to a close. Naira was whipped to the downside in the week as equities prices also treaded water, just as the central bank announced a 50 basis point rate hike, and the Senate asked the Tinubu administration to take the 50% windfall tax to 70%. And there's more to chew on in the outgoing week. Let's bring in our guests on all these topics. Mr. Johnson Chukwu, of course, market professional and group CEO at Cowry Asset Management. A good evening to you, sir. Thank you so much for joining us as always. So what do you make of the week that we saw here with the stock market, plunging today, the Naira now at 1,600. You've got higher yields on government securities. How would you summarize the week that was?
Thank you, Rotis, for having me. Let me start by thanking you for having me. I think what we are witnessing in the market, in the stock market, on a bear run was principally because of the actions of the Monetary Policy Committee. If you look at the MPC meeting, they increased the monetary policy rate by 50 basis points from 26.25% to 26.75%. Beyond that, the Treasury bills auction this week came for the 364-day instrument at a print of 22.1%, up from 21.24%. And the net 182-day bills was at 19.5%. So these are incentives that moved investors away from equities into fixed income instruments. So that's actually what drove the negative performance in the equity space in the outgoing week. In terms of the Naira exchange rate, of course, we have seen a presumed accretion to reserves about 37 billion. But then, if you look at those sources of inflow, they are largely driven by portfolio investors. It's basically portfolio investors who are buying up Nigerian fixed income instruments. And the amount that was sold this week was only about 258 billion naira. So that means the inflow of foreign capital or capital in position in the country was not as strong as it was in the previous two auctions. And that could be part of the reasons. And also, you know that the central bank had intervened aggressively. I think they sold about $149 million this week to about 29 traders or operators. So, but unfortunately, we are moving towards what you call the demand season. You remember that we are moving towards a time when people pay school fee for their children. Schools in Europe resume by September. Then it's also at the time when people place orders for end-of-year sales. People that want preparing for end-of-year sales will start placing orders from August. July, August, September, hoping that the goods will come in around October or November. So if you have an increase in demand for foreign exchange without a commensurate increase in supply, which I had alluded to by explaining the amount of foreign treasury bill that was sold during the week. So that can explain why yields came down in the equity space. Yields climbed in the fixed income space. Prices came down in the equity space, and the demand for FX spiked that led to depreciation of local currency.
Thank you so much for the summary, sir. Now, speaking of foreign exchange, since that's where you left off, I want to get your view on the windfall tax, this one-off windfall tax that initially was 50%. It's been approved by the Senate, I believe, and now has been hiked up to 70%. On realized gains, I really want to get your thoughts on how they plan to get this money from the banks.
Well, in terms of how they want to get the money from the banks, it's easy for them. Once the banks are properly assessed for tax, for this windfall tax, the central bank can easily debit them and move the money to Federal Inland Revenue Service into the Federation account. So that shouldn't be a problem in terms of collection. The problem is that the windfall tax is looking at only one side of the coin. And let me explain to you both, Rotus. Banks have made unusual profit from foreign exchange positions they were holding, those who had positive positions in their balance sheets, who got their books positively. But then there's a flip side to it. The real sector businesses have logged in huge foreign exchange losses. These real sector operators, the banks are exposed to them in form of credit. And the level of default will certainly increase. So when you are going to see the increase in default because the borrowers or the debtors, the people that the banks have lent money to, have logged in so much exchange losses. Some of them have their shareholders fund wiped out. So they won't be able to meet the obligations to the banks. So you're going to see a build-up in the next couple of months of non-performing loans for the banks. And then the banks have to write down part of their shareholders' funds in writing off those loans. So with central bank at that point, or the federal government at that point, they fund the banks for losses incurred on credit as a result of the movement in exchange rates. So we must have to put these policies in context. You don't just look at one side of it. Yes, the banks have made exchange gains, but I can assure you that if economic logic is anything to go by, the banks are going to have an increase in their non-performing loans. They're going to write down those loans, and that write-off will impact their shareholders' funds. So while you take what they have gained in form of tax, are you going to give them a tax rebate for the losses that they will incur when they begin to write down on those delinquent loans that occurred as a result of the sharp movement in exchange rate?
Now, I mean, so that's one headwind. There's also, you've already mentioned the rise in yields for the fixed income side. So that's a reason for people to pull money out of equities and go into fixed. How many blows can the banks take at this point when you put all this together?
Well, I don't know, but I think we have to be very careful the way we are attacking the banks. The simple reason that when the bank's ability to intermediate in the economy becomes weakened, the economy will be the overall loser, as it's here. Today, the banks are going through recapitalization. The first thing that you did was tie their hands to their back in the course of recapitalization and say, look, reserves that were built over time are no longer qualified as part of their shareholders. And for me, I've actually spoken extensively on this. I say, take for instance the First Bank. The First Bank started the banking business in maybe 1894. So the reserves they incurred from those years till now, are you saying they are all doubtful? Are you saying they were all built up because you granted the bank forbearance? What of the new banks? If you say the old banks all suffer the same fate, what are the new banks? They are the likes of Globus Bank that started after the forbearances that the bank, central bank granted the banks. And then their reserve also did not qualify. So you can't really paint everybody with the same tar. You can't paint all the banks with the same tar. If the appropriate thing to do was, since you know the forbearance you granted them, reverse the forbearance and then recompute their reserve so that you have the reserve that is unencumbered or unaffected by any forbearance you have granted, and that should qualify their shareholders fund. But that's one aspect of tying their hands. Now, the banks are subject to 45% of cash reserve ratio. So when they take a deposit, they have to pay 45% of, they have to say that bank, we have to sterilize 45% of it. Two, you've increased the, three, you have increased the monetary policy rate to 26.75%, and you have also changed the asymmetric corridor to plus 500 minus 100, which means any bank that wants to borrow from the central bank will have to borrow at 31.75%. So what makes it difficult for the banks to go to the central bank to meet their short-term liquidity constraints or liquidity gap? So they have to resort to the interbank market, and the interbank market will be trading at about 35%, which makes it difficult for the banks to make good money. And then you have also introduced the windfall tax. Without recognizing the fact, the banks will also have to write off bad loans that were occasioned by share movement exchange rate to customers who do not even have the liquidity, whose balance sheet have been completely wiped out. And then, so when you look at all these things, we just need to be careful the way we are pushing a major segment of the economy.
Thank you so much for that. So what's your view on, so what if someone was to say, Mr. Johnson Chukwu, what is the view on banking stocks? Do you stay away from banking stocks now? Because I know the index has been pummeled with everything has happened. That's the banking index on the NGX. Or is it a buying opportunity because banking stocks are cheaper now? But then there's also the recapitalization thing going on. What does one do in terms of, because it's the most liquid, the most liquid activity on the NGX is the banking sector. So how do you play banking stocks now with everything going on?
Well, I would never advise anybody to, like I said, you don't use a blanket, you avoid the generalistic, making a general statement about a sector. There will be banks that I will ask investors to still to invest aggressively and to take positions now that the prices are suffering some level of bearish run. And there are some banks that will advise investors that you hold. You know, if you look at the kind of advice we give, we can actually tell you hold, buy, or sell. So some of the banking stock will still qualify for hold position, so don't buy additionally, but don't sell. Some will qualify as buy, and some will qualify as sell. So the peculiarity of each of these banks differ. Their financial strengths differ. The impact of these policies on the banks also differ. So when we look at, if you are an investor, you come to us, we will take a critical look at your investment objective. Are you investing for speculative purposes that you're looking for capital gains? Are you a strategic investor that is going for the long term to be involved in a long-term core ownership of the financial institution? So we'll advise you on which stocks to buy. But some of the banks still present buy opportunities. Some are sell in certain situations, while some are just hold.
All right, and I guess with the MPR being increased now, what about, so let me extend that question out to the whole of the NGX, the stock market. How would you, I guess, view the market going forward if inflation continues to rise and we continue to see the hikes like we saw this last time? Are people going to keep moving to fixed income? And what's your view on the general market then if that keeps happening?
I think, Lotus, if we have to go by classical economic thinking, I would expect that investors will begin to underweight their portfolios in variable income assets, which includes equities, and overweight them in fixed income instruments. The effective yield on a 364-day instrument at the discount rate of 22.1% is more than 26%. So you are almost equalizing the inflation rate. I mean, if you are approaching 26, 27, 30% return, yes, there's still a negative real interest income if you invest in T-bills. But then the equities market had already gained more than 30% this year. So would anybody expect that in the next 1 year that there will be another gain of 26%? Because that's the assumption that we premise you are saying, and let me aggressively accumulate equity. So if you are investing for return purposes, of course, I must also emphasize that there are different investment motivations for investment. Some people are investing for strategic purposes. Some are investing for regular returns, so they're looking for an instrument that will give them interim dividend and final dividend. Some are investing as short-term holding assets for speculative purposes. So depending on your investment objective, or if your investment objective is just you're looking for capital gain, so you're looking for capital appreciation, then it will be surprising if the equity market would do another 26% as comparable to the yield that you would get if you invest in fixed income instruments. So like I said, if the classical economic thinking is anything to go by, one would expect that investors, the price of equities will continue to correct as long as the central bank continues to increase interest rates in their efforts to fight inflation.
Thank you so much for that. Mr. Johnson Chukwu, I want to ask you, does the market care about other issues going on, like political issues? So, for example, this cost of living, maybe I shouldn't call it a political issue, maybe a social issue, excuse me. These planned protests for, I guess, the first week of August, there's been a lot of back and forth. Well, how do you think investors will prepare for that? Do they care? I mean, we had the labor unions strike in the past over minimum wage, so on and so forth. So do you think the markets will shrug that off, or do you think they will pull out before the protest is to happen? How are you viewing that dynamic?
Well, what I would say is that the market is not inured to the larger economic issues, social and economic issues in the country. Of course, if there is a demonstration that makes it difficult for people to move around, then the market may not be able to open. Of course, though we trade largely electronically today, the market actually can function even if people are not moving around. But then there are levels of disruptions that will be difficult for the market to operate. And then the market investors are Nigerians. If you have increasing level of poverty, increasing level of economic challenges, of course, retail investors in the market will decrease. And even if you look at the institutional investors in the country are largely the pension fund administrators. And the pension fund administrators get their cash or liquidity from contributions or deductions from retirement savings accounts. So if the economy weakens further and unemployment rates spike, well, that means the amount of money that goes to the pension fund administrator will decrease. So the amount they have, the investable fund they have that will ordinarily go to the market will also decrease. So the market is not completely ignored to the larger social and economic development.
I want to quickly squeeze one more question, one more answer out of you. This $500 million diaspora bond, this dollar-denominated bond, how do you think it's going to work out? Are you bullish or bearish on it?
Well, I think I wouldn't say I would be bullish on it, but I think the government will be able to pull it through, provided the yield on that diaspora fund is attractive. It has to be something that at the minimum compares with existing yield on Nigerian government Eurobond instruments. So if it is marked to market and the yield is marked to market, then I think expect that it should be a successful offer. But if the offer is made at a yield that is below the return expectation of investors, and investors would rather buy other Nigerian issued dollar-denominated instruments, because the other Nigerian issued dollar-denominated instruments in the market. Nigeria has multiple Eurobond instruments, multiple maturities in the market. So it must be offered at a yield that is comparable to the Nigerian instruments traded in the market today of similar maturity.
Fantastic. I have so many more questions. It's always a pleasure to get into your knowledge, your wealth of knowledge on the market. So we appreciate your time. Mr. Johnson Chukwu, Group Chief Executive Officer of Cowry Asset Management. Thank you so much for talking to us.